We have to thank the Cider Gallery for providing us the space for almost, it's been 2 years. A big thank you to them, and for Zeus Coffee that's been providing coffee for all of us today, also for the past few years. And here are some, we've got, you can, I guess, Twitter and go online and check this thing out. Yeah, I don't do that very much, but for anybody who wants to do that. Okay, so today we've got Carbon Financial, and it is a, we have Ben here that's going to be speaking to us, and it's, I would say, education, if you will, for millennials about finances, and he's got a pretty interesting concept. So, Ben?
Thank you so much. So, yeah, I wrote up there, try carbon, if you didn't want to tweet at us. I haven't really taken off on the social front of this, but hopefully it will. So before that, thank you all so much for coming. This does mean a lot to me. This is something I've been working on for a while. I hope you guys will appreciate what I'm doing here, and maybe you'll see the value in what I'm trying to do here. So, like I said, my name is Ben, and I'm one of the founders of Carbon Financial. My co-founder couldn't be here. He's actually in Arkansas right now, which is unfortunate. But hopefully, he'll enjoy this nonetheless. So Carbon is, I like to start with our mission. So what we're trying to do. So Carbon Financial, I went too far forward, that's the problem with them. So the millennial generation doesn't trust the market right now. So what Carbon's trying to do is to get the millennial generation to trust the stock market and to start investing smart. I say start quite literally. So there's two key points here. There's trust, and then there's smarter. And I'm going to talk about both of those. The latter, smarter, is what I want to talk about first. So you just saw this, and this is an interesting little graphic. And basically it says that I am smarter than you guys. Exactly, right? So this shows the percentage of 18 to 24-year-olds over the last 40 years and those who attended college, right? So you can see in the last 10 years or so, that line has kind of shot up there to the 40%. So maybe from when you guys went to high school or went to college, a lot more of my generation is going to college. So on paper, the millennial generation is the smartest generation there's ever been.
On paper.
So on paper, right? So yeah. So because we are such a smart generation, we like to look up to some of the big guys. So we think of Warren Buffett, right? So a couple years ago, Warren Buffett was asked, really famously, "What are your rules for investing?" Right? And Warren said, "Rule number 1: never lose money." That easy, right? And then the second thing he said was, rule number 2 was never forget rule number 1. So being the smart millennials we are, we said, hey, we should take this advice seriously. And we actually took it too literally. So we said, if we never want to lose money, maybe we just shouldn't do anything with it, right? So this is asset allocation between generations. So what you're looking at here is, in the blue is millennials, and the red is everybody else. So the red is a little more normal. And what we see is that asset allocation is weighted more towards stocks and less on cash, right? Cash is liquid, but you're not going to retire on just cash, right? But you can see that millennials here are shoving all of their cash under the mattress, well, 52%. This was a study done by Fidelity Group last year for millennials. So this basically tells us that this is a problem. And this kind of discrepancy between the two graphs is actually heavily researched. It's called the stock market participation puzzle. And it really looks at why is this not happening. So I've talked about being smart. We've all probably seen this before. This is a compounding graph. Really simple, right? So if I invested $1,000 today and compounded at 8%, what would it look like in 60 years? I know I'm not going to retire at age 80, but it works out pretty perfectly. It's about $100,000 if I started at age 20, right? And then you can see as you tick along 5 years, the gains slowly diminish, right? So we're smart. We all understand a smart investor starts early. So then I throw this one up right after it. This is the S&P, Standard & Poor's 500 over the last 50 years. You'll notice even though there's some spikes in there, they start and end at exactly the same place. So the average return of the S&P 500 over the last 50 years is approximately 8% annually. So a smart investor is going to realize this, right? So the problem, though, is if we are such a smart generation, why aren't we investing? And it's because the millennials are afraid of losing money in the stock market. I showed you on that last graph there. In the last 10 years or 15 years, we've seen two of the biggest stock market crashes in U.S. history. The second largest one was in 2008, 2009. We're all familiar. And then there was the dot-com bubble that happened in 2000, 2001. So maybe you can't blame us, right? That's most of my lifetime, and we've had two of these huge crashes. So maybe we're just in saying we don't trust the market, but it doesn't. That's not. You can't retire on that, right? There's no future there. So because of that, studies have suggested that because of this extreme sense of risk aversion, coupled with higher levels of debt, so college is more expensive obviously, and the chance that I am likely never going to see Social Security in my lifetime, is that the average millennial won't retire until age 73. That's 12 years later than the current average. That scares me as a millennial, and I think it scares a lot of other people too. And it should scare people into saying why what we're doing now isn't working. So that's where Carbon comes in. So Carbon is an opportunity to start investing smarter. And I say each one of those very deliberately. I say start deliberately because the millennials aren't investing, right? I showed you that graph. People are keeping their money in stock, or in cash rather, not stocks. So they need to start. And then invest smarter. So smarter is a really general term, right? But there's a couple things we can do to be smarter. So I like to start with a quote from Paul Jones here. Paul Jones is a very successful hedge fund manager. He said defense is 10 times more important than offense. He said if you lose 50% of your money, it takes 100% to get it back. And that takes you something that you can't get back, time. Paul is absolutely considered one of the 1% of America. So I think we can agree that Paul is a smart investor. And smart investors agree that it's better to protect wealth than to attain it. So Carbon has three main benefits here that we're able to offer. So the first one is Carbon is an automated investment service that allows for a passive investment strategy. So I went out and I talked to people, I talked to millennials, and I asked them, what does your financial situation look like right now? What are you doing? And the overwhelming consensus was, well, almost nothing. But if they are, it's not active. So think of the two ends of the spectrum, right? You have your E-Trades of the world, which are, I'm going to go invest myself, and then you have the Edward Jones of the world, where it's, I'm going to give somebody else my money and let them do it for me. And both of these scenarios don't work for the millennial generation, because they're not going to trust a financial advisor, and they're not going to want to do it themselves. So there's really this middle ground that doesn't exist. The second thing is companies you know. So when you're talking to a millennial, or somebody who maybe didn't get a financial degree, and you tell them, you say, oh, what are you investing in? Or what should you be investing in? A lot of people draw a blank. And if you go to the Edward Jones, or you go to another online investment service, and you tell them, oh, I'd like to retire, 65. They're going to say, well, I think we should put most of your money in a ProShares large cap Russell 2000 ETF. And they're going to look at you and say, I have no idea what that means, right? Right. But instead I can say, oh, what phone are you using there? Oh, you have an iPhone? Do you like Apple? Is Apple a good company? Apple's had significant growth in the last 10 years. Just added to the Dow, actually. So Apple's a company that people relate to. That's true for a lot of companies, right? So rather than pushing index funds and ETFs, push things people know, the companies that we use every day. And then the last part is a unique risk profile. And this is where Carbon is really different. So as opposed to anybody else where you're going to approach them, and they're going to say, oh, you want to retire in 40 years, so let's put, most of your money in ETFs instead of bonds. Carbon does it differently. Carbon does it through hedging. So, and there's two main points here. So our big differentiator is we're able to hedge using option-based strategies. If you've never heard of an option is a financial derivative. And essentially it's a contract that lets you buy or sell a stock at a certain point in time for a certain price. And you can leverage these in some cool, nifty ways in order to essentially guarantee certain returns over periods of time, or at least cap downside, right? Which is what we're looking at. More on that in a second if you haven't followed. And then the second part is pooling like-minded investment capital. So I say that because if you do understand options, there's two limiting factors of why they're not used today by a lot of millennials. One, they don't understand them. If I explain it to you today and you still don't understand it, that's the first part. And the second is they're expensive to use. One option contract covers 100 shares already. So for some stocks, that's okay, but for example, Apple. Before they had a stock split, you would need $50,000 of Apple stock just to use one options contract as cost effectively as you can. Today, that value is still about $10,000, which represents more than the average millennial is likely going to start investing with. So I talked about option strategies, and I know this might look confusing, but I'll talk you through it. So this is a collar strategy, and it sounds exactly what it is. It's a collar, right? So imagine the stock market going right through the middle of that. Using a collar strategy and option strategy, we can essentially cap downside and we can cap upside. And you're probably thinking, why in the world would I want to cap my upside, right? So think of options as insurance, right? Insurance isn't cheap, but in order to make it cheaper, we can kind of sell the upside. So this helps kind of negate the costs. It's not, one-to-one, but it helps bring the cost down, so it's a realistic strategy. So this is another big hedge fund manager, Kyle Bass. He was interviewed a couple years ago, right after 2009, when we were kind of at the low point, and he had made a significant amount of money at that time. And people said, Kyle, how did you do it? This makes no sense. Everybody else is hurting, how did you do it? And he said, the way I produce such huge returns is I risk only 6 cents for every $1 of upside. So at any point in time, what Kyle was saying is that he was risking 6% downside in exchange for 100% upside. So the graph you're looking at here is the Dow Jones over the last 10 years, so 2005. And you can see the red is what it would have looked like if you bought in and you still held it to this day. So you would be, a moderate return. It looks like 17 maybe. But this is where it gets really interesting. So I went through and I said, once per quarter, I looked at the data that I was given, and I said, is the Dow down more than 6% of where it was on the first day? And if that was true, that became his max loss, 6%, at any point in time, and then it repeated. And if you do that over 10 years, you can see how much more money Kyle would have made in this. And that is exactly what he did. And the beauty of this is that these are actual strategies that we can use towards millennials investing. So the best part of this, though, is that this isn't new. I didn't invent it. Derivatives and option strategies have been around for a long time, but it is to our target audience, and it's because of two things that I talked about earlier. Because they lack the education, one, to use these strategies effectively. So even if I told you, I'm not sure if you would have the knowledge to go execute them yourself, and that's the beauty of what Carbon offers. And then the second thing is capital. It's like I talked about earlier, when we combine investor funds from like-minded ideas, we're able to do it as cost effectively as possible. And that ultimately brings the cost down for the first-time investor. So I wanted to talk through a quick process of what it might look like today. We are rather early venture, so bear with me on this. So the first-time investor, millennial, just graduated college, maybe just got his first salary job, deciding to start investing for my future. So they would go onto our site, trycarbon.co, not .com, it's .co. You would be amazed how hard it is to get a domain name in this day and age. But nonetheless, they'll go to our site, hopefully they'll agree with us, and they'll sign up, and they'll get this fantastic little email that says, thanks for your interest. I'd love it to say, let's get going now, but it just says, thanks for your interest, because some key pieces are missing here. So once they get that email, they hit set up, they're going to be pushed through. So I put this little caution tape up at the top, because this isn't totally ready yet. But I'm excited to show you. This is lots of work in the making here, and ultimately what we want to offer is this personal dashboard that a millennial can relate to, right? We are the technical generation. So as opposed to the Edward Joneses of the world, where they're going to hand you financial statements, these aren't things that a millennial wants to see, right? So this is the automated aspect, and it targets the generation at our heart, which is technology. So to conclude, I'd like to explain Carbon in one sentence. So Carbon is an automated investment service that is passive, that focuses on risk mitigation of investments using some of the Wall Street expertise designed for everyone. So with that, I would love to take your questions. Yes, sir.
You had mentioned on that dashboard, for example, that is, I'm not sure you said that would be the only information available, but, when I do read through the plenty of stuff that my American Fund sends me and everything, there's an awful lot of legal disclosure and things like that. I mean, how do you anticipate your dashboard being able to meet those types of disclosure requirements?
Yeah. Okay, thank you so much for the question. So you've touched on a key point here that we're looking into now, which is legal. So the reason that I can't say sign up today and let me start investing today is because we're not a registered investment advisor yet. We're not certified by the SEC, unfortunately, and we're not certified in the state of Kansas to do that. We're not a broker-dealer either, so I'm throwing terms around here. Registered investment advisor basically says that I have the right to invest your money as I see fit, and I'm doing my fiduciary duties in order to grow your assets, right? So the first one is when you're signing up for anybody, you are essentially signing over your rights to a registered investment advisor. And then the second part of that is a broker-dealer, which is maybe what your TD Ameritrade or your Schwabs are, because these are the big guys, right? These are the guys who can actually go process trades. That's not what Carbon is trying to do. So a broker-dealer is essentially, we would use a broker-dealer, but a broker-dealer is essentially the one who's talking to, say, the New York Stock Exchange, and they're saying, hey, I want to buy this stock. That's what a broker-dealer does. So hopefully I touched on some of those points there, specifically to the dashboard. The dashboard is just kind of an overarching theme in that, you know, we wanted to put tools in the place of the millennial. If anybody's ever used E-Trade before, and I know I have a couple of years ago, when I started investing, I thought, you see those E-Trade commercials and they say, it's so easy, a baby can do it, right? Absolutely not the case. A baby could not do that. So, yeah, so the goal is, how do we make it simpler? How do we take out some of the, you know, there's just unnecessary information. And the heart of the dashboard is how can we paint a picture of the financial market and of your situation as clean as possible. So hopefully I answered your question. Yes, sir.
So, do I understand you correctly? Tricarbon is basically, you're a hedge fund.
So, kind of not really. And I say that because, so people who are familiar with hedge funds are typically, they have really high requirements, right? A typical hedge fund requires an investment of at least $1 million.
Right.
And hedge funds are really great because they're unregulated. And because they're unregulated, they can do a lot of things like hedging strategies, right? But they can do it a lot more efficiently. So I've heard the term for what I'm doing is a mini hedge fund.
Okay. Well, then the follow-up question to that is, if I understand it, then you build wealth through exercising options.
Not exactly. So the options are more in place for protective reasons rather than building wealth. So in all of these scenarios, there's still underlying securities involved. So in the example I think I put up earlier, somebody might come to us and say, hey, you know, I really like my Ford car and I really like my iPhone. So two companies that I trust are Ford and Apple, right? So they might be able to say, hey, you know, let me do 50-50. Any financial advisor is going to say, whoa, you are not diversified at all. But the beauty of this system is that because you're hedging, you're eliminating all that systematic risk in the process. So even though diversification is a great strategy and it's been proven, market portfolio theory, it's not as necessary in this. And the long-term goal of this process is that once we've rebuilt the trust in millennials of investing, we hope to transition them over to some of the more traditional methods of investing in the stock market. So the options are strictly in place for a protective reason because it really looks at the heart of why somebody isn't investing right now.
Who exercises the options?
We do. Yeah. So let me give an example. So say,
excuse me for interrupting. Do this millennial market we're talking about? Do you take this pool of money to them? Is that what you do? I mean, or is it you exercise individual options for individual investors?
So
I mean, do you do it collectively or do you do it?
Yeah, it's done mostly collectively. So let me give an example here. So say I have 10 investors who each have 10 shares of Apple, right? And Apple's trading at 107, I think. Maybe I don't know. Anyway, Apple, we're going to say 105 to make it easy. So let's say the most I wanted to lose, the most they could afford to lose was say 5%. Pretty realistic. So we would go by the put option for say 3 months in the future. So strike date, strike price of $100 on that Apple, and then we would sell the call, the upside. So maybe 115, right? So that's capping our upside, and that because we're selling the call, we're collecting a premium. So it's helping us offset the downside there. And then the idea is after 3 months. Well, the part I'm skipping here is because we have 10 investors here that are each buying 10 shares, we only need one contract between all of them. If they were to do that individually, they would each be spending 10 times as much money as they needed to do it effectively. So that's the idea behind pooling investor funds, because they represent like-minded ideas. And I'll be the first to admit the model really only succeeds with volume. So, you know, if we only have 10 clients and they don't all want Apple, then it does become difficult to do that. And we're able to solve a lot of that problem by cutting out a lot of maybe what like E-Trade has to offer. So between the two big indices in the U.S., there's probably 8,000 stocks. They're not all good investments, we know that. So Carbon is able to kind of handpick them, think large cap stocks, you know, growth stocks, value stocks, and we kind of offer those in a platter, so to speak, and then we combine them with options so that we can say, hey, this is the most money that you can lose in a period. If the market crashes the next 3 months, your money's protected. Hopefully I answered that. Yes, sir, in the back. Yeah. to.
Okay, great. So I guess related to that, follow-up question would be, with education, if I go to your site as you envision it, because I know it's not completely finished right now, let's say in 3 months or whenever you think it's going to be ready to go, and I sign up, what education am I going to receive? Let's say I do like Ford and Apple, and I say those are my two and I just want to stick with those. What education am I going to receive, if any, about options? Am I going to learn about how that works, why it's important, why I should trust you?
Yeah, great question. So here's the best part. You don't have to know how options work at all. That's all happening in the back end. And it comes out in a fee, right? So maybe you pay a fee to your investment advisor. You do the same thing to us, but we're going to say, hey, we're going to guarantee that the most you can lose over, a 3-month period is, 3%, right? And we can do that through options. Now, I will be the first one to tell you how we do it, but the thing is a lot of millennials don't care how we do it. They don't want to know how we do it. So, and then you talk about the learning or the experience here. The learning isn't to learn an option, so to speak. It's to transition somebody to trust the market more. So there's a couple other quotes that I didn't throw in here from like the 1%, and they essentially say some of the best investments you can make today are index funds. There's a reason people love index funds. It's because they work and they follow the market, right? So the ideal strategy for anybody, generalizing everybody, would be just index funds. But index funds are risky, right? At any point in time, there's, I think it's 15% systematic risk in the market. You could lose 15% tomorrow for all we know. And that's what scares the millennial generation. So how do we eliminate that risk, and how do we build up their trust in the market to the point where we can transition them from this process of having to hedge every option? Because I'll be the first to admit, it's not free to hedge. But what we're offering is, we're offering peace of mind. So then the long-term strategy is we transition somebody to the more universally accepted standards of investing practice. And we can do that cheaper. Yes?
Why is it a good thing to foster that kind of ignorance?
Can you be more specific? Like what type of ignorance?
You say because millennials don't care, why not try making them care instead of making it easier to be ignorant about millennials?
Okay, yeah, so excellent point. So, is anybody here a financial analyst? Fantastic. We have a handful here, right? So, for those who didn't raise your hand.
Excuse me, I'm not a financial man. I'm an investment advisor representative.
Okay, so, for those who didn't raise their hands, you don't want to make it your day job to learn options, right?
Right.
You just know that they work, right? If they work, why do you need to learn them? And I will teach them to you. I'm happy to, but that's not what. I don't like to call it an ignorance, because what we're looking at the pain points that somebody else in the market isn't solving. So there's, if you go look at somebody who's a competitor of ours like Wealthfront, very, very popular automated investment service, and you go to them and you say, this is how much money I have, which by the way, it's a $10,000 minimum to get into them. And then you say, when I want to retire, and they say, here, we're going to push your money into these ETFs and a couple bonds, and that's it, hands off. It's pretty cool, I'm going to admit. But in that approach, they are assuming that whoever's investing in them can get over that mental mindset that I don't trust the market and that there's risk involved. So I don't like to think about it as ignorance as much as we're trying to target the pain points why somebody isn't investing. So hopefully that answered it. Yes, sir.
That I kind of have the same analogy. It's like if you want to buy a car and the car salesman says, well, hey, you want to buy this? Well, first you got to know how to take it apart and how all mechanics work and everything. It's like, I just want to drive the thing.
That's a fantastic example. Yeah. So and I use the example of insurance to generalize options, because that's kind of what they can be. There's obviously a lot more depth to options, but in a basic sense, in the way that we're using them for our clients, that's the way that they get explained about. Yes, sir.
So what do I see as the end user? I say I have 10 shares of Apple and it's at 107. You have these contracts. You have a put at 101, 100.
Yeah.
Say it drops down to 98.
Yeah.
Do I still have those 10 shares in my account, but I have some cash to compensate me from this call or put or whatever it is? Or do those get liquidated from my account? And what happens? What do I see?
Yeah, so you're describing some of the nitpicky details that I'll be first to admit don't totally exist right now. But the way that it has been envisioned and that I'm confident will work is, so these all kind of work on cycles, right? So think every quarter. You decide you want your 10 shares of Apple, and then we can bulk process that order with everybody else who does it. At the end of 3 months, even during the 3 months, you might say, well, Apple's down. But at any point in time in your dashboard, it's going to say that your investment is protected to $101 no matter what per share. So if Apple goes to 96, you are still online. You're going to see that your unrealized portfolio value is no less than $101 per share times the amount of shares you have. And then at the end of that 3-month period, if it's still below, Carbon will exercise the options on your behalf so that we can recollect it. And then if you decided not to change your strategy, we can just reinvest you back into Apple.
But if I see it went to 129, like I think it is today, then
Yeah.
I might be a little upset that, hey, why do I not get that realized value? Or
So you are going to realize some of the value, and that's the beauty of options, is that they're really flexible. So if you are, if you're one of the more risky investors, which millennials aren't, but maybe you are, you might say, or when you did your quiz, you might say, hey, I can afford to take some risk. I'm young, I can do that, right? You might say, I want to be able to have the opportunity to have a large upside, especially with Apple. That's a company that booms, right? So because of that, you might take some more risk for it, right? And there's all sorts of variations of this process.
But if I don't take that risk, I see an explanation for why it's at 129, but my realized gain is at 120. So
Yeah, exactly. So yeah, so it goes back to what a collar is, and we can explain that. We can say, hey, if you want to up your bring your upside up, the premium to do that gets a little higher. So the question is, what is the delicate balance between upside protection or upside cap and downside? So what's the ceiling and floor, and how can we make that cost as little as possible to the first time investor?
And are you doing this manually, or do you have software?
No, this is, right now it's being done manually, so I say that because I wouldn't be here today if the strategies that I'm doing didn't work, because that would be a lost cause, right? So they're being done manually now, but the goal is, and what we're working towards now, is the automation of these processes. And that happens, I talked about some broker-dealers earlier, utilizing some of the more big industry players who can help us kind of process these transactions and such. Yes, sir.
I was wondering if you could throw out a general timeline for your business. From when did you have this idea, what kind of finances, or how did you find a partner for it, where you're at now, and how long, because there's a lot of things you're talking about, a lot of dreams and goals and stuff you're working on. I was wondering what the timeline looks like for
Yeah, absolutely. So that's a fantastic question. So I've been working on this for about 2 years. Not to scare you, it started off as something completely different. And it started when I started investing for my first time about 2 years ago when I went to E-Trade. Right? I talked about the example, so easy baby can do it. Absolutely not the case. So I thought there has to be a better way. So Carbon originally started as a platform for active investing. I thought there has to be a better broker designed for the first-time investor, that strips out a lot of the unnecessary detail. But then when I went out and I talked to the customer said, I don't want to actively invest my money. I want somebody else to do it for me. So that's how Carbon kind of morphed into this more automated. So what we're at now is we've kind of entered this market validation stage. So the goal here that hopefully you'll see on our website and hopefully that AfterTrade today is I'm trying to sell you the idea, right? And then if we can build enough backing to do that, it'll kind of help us in our growth. So if if in a year I go approach some big name people to get this to happen, they might be a little skeptical if I say, well, I've got 10 people waiting to sign up, right? There's a great example. There's a startup based in Silicon Valley called Robinhood. Maybe you guys have heard of them. Robinhood is fee-free investing. It's a pretty great concept, and I would say they're a competitor, but they're really not, because they're an active broker and we're more passive. But their model is really interesting because they held out actually launching their product until they had 400,000 people waiting to use it. So you can imagine if you had a list of 400,000 people waiting to use it, you might have some more support. So in a more general timeline, what we're doing here, my co-founder is actually my brother. He's a few years older than me. He just graduated with his computer science degree. He is in Arkansas right now. He's being heavily recruited by some other tech companies. So I'm hoping he'll stay with me, and I'm confident he will. Right. So everything I've shown you today, and at least on the website, was about 2,900 lines of code last I checked. And that's to do almost nothing. So you can imagine we have a ways to go. Our long-term goal is by the end of the summer, we are looking for our legal. So there's a lot of things we can't do without being legally registered, right? So if you scroll to the bottom of our website, there's a great little disclaimer that this is all for educational purposes, and that's only because I can't legally tell you what I'm doing without it being for educational purposes. So by the summer, we're looking for more legal certification, And then next fall is kind of market validation. Do we have people waiting to use it? And then spring is let's push it out, right?
Great. And so is this what you're doing full time? And if so, what do you get money to eat and live on?
Yeah. So this is not my full-time job. I am actually a student at the University of Kansas. I am studying finance. Hopefully that makes me more qualified here. So I like to say that my first full-time job was being a student, and this comes second. But it has dominated a large part of my life, and it's it's like the guy we had last week talk about. You know, he's looking for an opportunity to quit his day job, and for me that's graduation, which is looming. And the goal is build up enough where I can go straight from my degree to funding this, right? So, not full time, pretty close, but
Great.
more than I care to admit.
Great. Thank you.
Way in the back.
From a 30,000 foot level, I would say, you're saying that it's your primary selling point then is trust, right? You're trying to get the millennials to trust you, right? Is there some huge difference in how millennials perceive name recognition, brand recognition? What are your thoughts on that?
Yeah, so you touched on a good point there. So I bring up Edward Jones a lot because Edward Jones is an example of everybody knows who is maybe who my mom and dad used to handle their finances, right? Fidelity, that same survey I showed you, they have a lot of other statistics that talk about what the millennials, who they trust. The number one person millennials trust for financial advice is their parents, right? So, and like 6 on that list is a financial advisor. Because we want to do it ourselves, and that's why I talk about kind of the technology aspect of this. The automated investment industry is so new, but it represents a paradigm shift for the industry. Because it's taking technology and strategies that have been around for decades. Modern portfolio theory was first 1950s when modern portfolio theory was announced, and we still use it today, right? But the idea is automating it makes it cheaper. So you talk about kind of perceptions and trust. I think the goal isn't, I hope they're going to trust us, but the idea is, Carbon has a social benefit of we want to get the millennial generation to start investing earlier, because the smarter investor starts investing earlier. So, trust, yeah, that's a good point. Yes, sir.
Following up on trust, and bringing it back to the analogy about car dealers, I don't necessarily trust car dealers, but when I go to buy a car, there's a sticker on the side that tells me everything that's in that car. And I think it's putting you at a disadvantage to not give the option for the person to educate themselves on your site, because there are those people who want to educate
Oh,
themselves.
I'm not saying I'm not.
Okay, I thought
It exists, yeah. If you go to our site today and you do /FAQ, so frequently asked question, I have a whole section. I've written paragraphs on how we do this. And it talks about options, and it talks about the market, and all that fun stuff. So the opportunity is there if you want to, but it doesn't represent a large percentage of our user base, we should
Gotcha.
say. So the opportunity is there if you like.
because back to the ignorance question, it seemed when you answered that question that you weren't actively trying to educate the customer, but that you would answer questions. Now I know that it's actually on the site.
Yeah, so
That makes a lot more sense.
the education, we're not so much trying to teach them about options, we're trying to teach them about, investing and the value of investing, so that hopefully they can transition from maybe owning Apple and Ford to being more diversified, right?
And then a follow-up question to that. So let's say you have the people who have more aggressive investment strategies and
Yeah.
the people who are more passive. So you're going to have, 100 shares of this option at, an aggressive level and then 100 shares at the more passive level, or can you divvy up the 100 shares between different options?
So it's the former in your example there.
Okay.
And that's, like I said, the model succeeds with volume. First off, it works well because we can limit the amount of stocks to say 50. Think of the Dow, right? Even 30, the Dow 30, right? So by doing that, we can kind of already limit the amount of stocks that people can pick from, and then we can kind of vary the strategies only ever so slightly. So then we kind of have a dialed-in approach to what people want. And maybe I'm speaking hypothetically, of course. Somebody says, I want, 10 shares of Procter & Gamble, and I want 0% downside. We can do 0% downside, that's buying the put at the money, but that's expensive to do, and my guess is not a lot of people are gonna sign on to that idea. So what happens is it might pop up and say, hey, you know, this isn't a strategy that a lot of other people agree with right now. The alternative is, you know, maybe try Apple, or let's put your money in an index fund instead. What's an index fund? Right here, you know. So it's a continual learning process, and the goal is, you know, Wealthfront, all these other services aren't targeting the people we are, right? I love to give the example of tobacco companies. When you see a tobacco company on TV, they are not trying to convince you to start smoking. They're trying to convince people who already smoke to smoke their brand, right? We're kind of doing it the other way, which is why nobody else is going to touch this model, is because we are targeting people who aren't investing. You know, when you see an E-Trade commercial, it says, you know, switch your IRA, switch your 401k. This isn't switching, this is starting. So, yes, sir.
Ben, how would you reach those people that aren't investing that you're talking about? If you wanted to educate them, how would you reach them out to scale your business?
Yeah, so fantastic question, and that's one of the things we're working on today. So we recently got a public image, so to speak, of what we're doing. So the goal here is aggressive marketing and word of mouth. So I used the example of Robinhood earlier. Robinhood did an interview about a year ago, right before they launched, and they said, how did you get such great support? And they said, we don't know. They didn't spend $1 on marketing, ever. So the idea here is word of mouth, aggressive advertising. You know, if millennials can wrap their mind around the idea that we can, you know, offer an opportunity to start investing, you know, do something for your future, I think that kind of sells itself. But there's going to be significant, you know, marketing humps that we have to get over, and that starts today. So hopefully I answered your question.
Well, how would you reach them? I mean, what specific?
Like what channels?
Yeah, how would you reach them?
Yeah, so I talk about a lot how the millennial generation is technology. So it's how can we put ourselves in front of kind of the technological channel. So the biggest thing is social media. The millennial generation will build trust on a brand or an image more from social media and what their friends say than any other aspect.
Okay.
So if I had
a core group to start with,
yeah,
yeah,
that's what you guys are, hopefully, right? So. Yes, sir.
Since you mentioned Robinhood, are you able to talk about your fee structure at this point?
I can. So it's unfortunately a little more complicated because the fee is really dependent on what you want to do. So I give the example of 0% downside. If you wanted to hedge absolutely no money loss from your principal, you would pay about 3.5% per quarter to do that. That's expensive, right? That's 12% of 14% a year. And it's not something a lot of people would sign on to, but the opportunity is there. And there's a variation from that where you can say, maybe I'm okay losing 5%, or you do what Kyle Bass did and say 6%, right? And then you can kind of cap the upside efficiently. So I wish I could be more specific on the fee structure, but it's really variable. And I can tell you it ranges from practically nothing, which is, I don't need the insurance, to I need all the insurance, 3.5% a quarter. And one of the strategies of that too is, sorry to cut you off, one of the strategies is how do we take a variable cost and make it a fixed one to our customers, right? So when I start telling people that it's 2% of assets under management, they're gonna go, whoa, you're getting technical. But if I say $15 a month, they can buy into that. This is a generation who spends $9 a month on Netflix and $5 for Starbucks coffee. So if you're telling me that the millennial sees a product like this that is for their betterment, for their future, and I'm telling them it's $15 a month, I hope they would sign on to that idea. So, was there a question in the back?
Yeah, your name, any thought, why did you choose this name?
Yeah, so
because it doesn't seem to indicate what you're trying to do.
Yeah, so carbon is an interesting name. Carbon is one of the most common elements in the world, right? It represents, I want to say, 70% of the U.S. or 18% rather of the human body. Carbon in its various forms can be graphite, it can be coal, and it can be diamonds, right? All valuable. So I like to give the analogy of that. Carbon can be lots of different things. Coal, graphite, diamonds. The stock market can be a lot of different things. Stocks, bonds, ETFs, mutual funds, right? And then it's, carbon is extremely important in everybody's lives. Whether or not you know it, carbon is important. And whether or not the millennial generation knows it today, investing is important. that's kind of the thought process behind the name.
Well, if there aren't any other questions from the audience, I think it's time for our final question,
Yeah.
which is what can we do to help you?
So, thank you for asking. The biggest thing is your feedback. This is very, very early on. All the questions I've got today are fantastic, but if you have more, please email me. It's ben@tricarbon.co. I would love to answer them, and I would love you to play devil's advocate too. Poke holes in this, please do, because that helps me see the problems now and pivot before it becomes a problem. So your feedback is absolutely the number one thing. And then the second thing, too, is if you know millennials, if you know somebody who says, hey, I'm not investing, but you know they should be, maybe push them my direction. I know I can't offer anything right now, but I'm trying to show support for what I'm doing, and that starts with building a list of clients ready to use what I'm trying to offer. So
Thank you very much.
thank you so much, guys.
So Ben can stick around for questions if you want to hit him up with any follow-up thoughts. I want to say a couple thanks real quick. Thank you to our sponsors, Seeds Divine Espresso for the coffee, Cider Offices Co-working upstairs for having entrepreneurial and freelance co-working space and providing this wonderful space for us for our events, and WarrenSits.com for being our media sponsor. They obviously stream everything, so if you miss a presentation some week, don't worry, you can go back and watch it. Now, without further ado, I want to do a quick follow-on announcement. Come on up, Jen. This is Jen from the Cider Gallery. Some of you may already know her. She's got an important event to announce.
It's very important because it's a KU watch party. I just want to remind you that we still have open office hours on Thursday, so anyone's welcome to come and work upstairs at the farm table. They can find Beth or I or AJ, and we'll give you like an internet code for the day. And just check out the space, give it a try. So if none of you have that need, just feel free to spread the word. We're doing that tomorrow, but we'll be downstairs with the screen down and the game on, and we'll be working from the gallery. Everyone's welcome. We'll have beverages. I think the office manager is going to bring some food, so if you want to stop by, you can bring some, or just show up and have a drink.
What time are your open office hours?
The office hours are fine. Same question. 1 to 4, 1 to 5 every Thursday. And then every Thursday at 4, we also host a happy hour. It's typically upstairs in our kitchen area, but this week we might still be down here with the screen down, who knows. We'll be somewhere in the building. Yeah, so you're all welcome. Thanks.
We'll see you next week or tomorrow.